From Deloitte Tax, welcome to the Tax News and Views podcast. In this series, we talk to specialists from Deloitte about the latest business issues. I'm Carrie Falkenhayn, your host for Tax News and Views. Today, we're going to be talking about property taxes. Now is the time of year when many property tax assessments are released, and given the potential significance of those amounts, it's an area where organizations will want to understand how the amounts are typically determined and how they might appeal assessments if they disagree with those. Joining me today are two of Deloitte's property tax specialists, Alex Marotti and Lucas Quarry. So, Alex, I'll start with you. Can you walk us through how assessing authorities come up with their values each year?
Sure. Thank you, Carrie. So the short answer is it varies. It varies depending on the jurisdiction or the property type, but assessors will generally use at least one of the three traditional real estate approaches to value. And those are the cost approach, the income approach, and the sales comparison approach. So starting out with the cost approach, simply put, the cost approach is formulated by taking the depreciated cost of a property's building and other real estate improvements, adding that to the value of the land, and that's how you come up with the total value of the property. So for example, some assessors may pull construction permits that show recent building or building expansion cost figures. What they'll do is they'll take those depreciated costs and then again add in a land value, right? Sometimes pulled from pulling sales, recent land sales per acre or per square foot in that jurisdiction. Those added together come up with your total cost valuation. One thing to note is that oftentimes for older properties, the assessors won't have access to the original cost or original permits. In these cases, what they'll do is they typically look at market cost subscriptions, other various real estate softwares that provide that market cost data, and that's how they'll come up with their cost approach value. The cost approach is often used for more complex or unique properties. So, when I think of this, I think of, your big manufacturing or industrial plants. And then obviously it's used for newly constructed properties. Moving on, assessors will also look at an income approach to value. For this approach, assessors look at market vacancy, market rents, expenses, cap rates, tenant listings to formulate an income approach to value. But for this approach, it should be noted that it's typically used for your more traditional commercial real estate properties and obviously income producing properties. So think of offices that are leased out, retail strip centers, hotels are good candidates for the income approach. Sales approach, right? Assessors will also look at recent sales of comparable properties when formulating their assessments each year. So they will adjust recent sale prices to the subject property, making sure they account for differences in age, size, location, quality, and that's how they'll come up with their sales approach evaluation. And oftentimes the owners or subject property, maybe it recently sold, so you don't need to look at market data. So that transaction right there could be a good indication of what that assessment should be.
So we've got the cost approach, the income approach, the sales approach. Are there any other approaches that or assessment bodies will take?
Sure. Yes. So uniformity is another approach to value that I think is worth mentioning. It's used in some jurisdictions, with Texas being the most notable. It's also known as the equity approach or equal and uniform approach. But basically, an equity approach factors in the county appraised values of other comparable property types. So, for example, let's say you own a drugstore in Dallas County, and the assessor is valuing all the other drugstores in the county at around, let's say, $500 per square foot. An equity approach would indicate that your property's value should also be at or around that same $500 per square foot valuation, right? So the key takeaway there is that it needs to be in line with its competitive set, or just simply put, comparable properties. One other thing to note there too is that, like the sales approach, you would want to adjust your equity comparables, differences in age, size, location, quality. Lastly, I think one other area that assessing authorities, one area that they use when coming up with evaluations each year is that, they have access from data submitted maybe on a prior year property tax cycle or prior year appeal. So, it should be noted that they're constantly trailing the market with their values in many cases. So, when I think of this, what comes to mind is, the COVID-19 pandemic and its impact on specifically the hospitality industry. So, with everything coming to a halt back in March, April of 2020, many hotels, resorts, airlines didn't see their property tax assessments affected till that following valuation cycle. So 2021, and in some cases, even 2022.
Got it. All right. So you talked, Alex, a little bit about how the sales approach and how sales of property can influence someone else's assessment. Lucas, maybe talk about what happens for the property itself that's sold. What does that transaction have? What effect does it have on real estate taxes the following year?
Yeah, well, definitely has an effect. I think the degree that it affects the property's valuation and real estate taxes depends on the jurisdiction you're in. So you have disclosure states and non-disclosure states. And a lot of these disclosure states, purchase prices are disclosed through reporting requirements or transfer taxes. And when that happens, the assessing authorities usually give strong consideration to the purchase prices when they're doing their reassessments. Now, there are some exceptions. So if you have a non-market transaction, such as a sale leaseback, or maybe a 1031 exchange, or a bulk portfolio multi-state transaction, there may be less weight given to that purchase price, but there still is some weight given to it, typically by the assessors. Now, there are other states which are non-disclosure states, meaning that when a transaction occurs, there is no reporting requirement for the purchase price. And Texas, again, is a notable one here. So when these transactions occur in these states, a lot of times the values do become increased, even though the purchase prices aren't becoming publicly available. But a lot of times during the appeal process, for Texas specifically, you can appeal that. Appraisers typically won't increase the entire submarket of your comp set due to a single transaction. And so, as Alex alluded to, you have the uniformity approach to appeal your assessment in the event that they raise you unfairly due to a recent purchase price.
Interesting. So, what are a few things that property owners should be thinking about and reviewing as they're considering whether they should file a protest of their property tax assessment? Alex, you want to get us started?
Sure. Yeah. So property owners and their tax consultants should look at a variety of different factors, data points when considering whether or not to file a property tax protest. A few common financial documents that, we review for property owners and clients, that come to mind are rent rolls, right? As of the assessment date, we'll review their year-end income and expense statements, trial balances, and any future capital expenditure items or expansion plans or details, something that we also want to review. Bottom line, if it's affecting your property's value and ideally negatively, you'll definitely want to file an appeal and have a discussion with the assessor. We'll also look at if there are any recent appraisals that were obtained during the underwriting process, or if any appraisals were commissioned during the prior year appeal or litigation. Those are definitely something you'd want to review before making that decision. We've talked about the sales approach and recent sales a lot. So if a property recently sold, you would obviously want to review those final closing docs. That's a very important step to try and extract what that actual sales price was for the real estate, meaning, the land and building improvements, because that, from a property tax valuation standpoint, that's what should be considered. So if an assessor is using your property's recent sale price as a justification for their value, you definitely want to analyze whether there are any non-taxable or intangible items that could be removed potentially. Physical condition of the property is something that we also, or should also be reviewed. We'll typically ask clients if there are any large deferred maintenance items that they have, such as the need for a new roof, or maybe it's repaving the parking lot. These definitely need to be taken into consideration. Occupancy rates, especially occupancy rates for income producing properties, these also need to be reviewed. Jurisdictions will generally utilize mass appraisal techniques when valuing properties. So in many cases, they're not aware of vacancy issues for specific or your individual property. When I think of this, This holds especially true for offices. Recently, office vacancies have soared across the United States. Worker attendance is still lagging pre-pandemic levels. So if an owner's office property was fully leased out and occupied in prior years, but now has fewer tenants, there could be an argument that their property's valuation should be lower. Tenant quality, right, Lucas? This is very important as well.
Yeah, it's definitely a big one. Circling back to your approaches to value, this would be more on the income side for income producing properties, really pertaining to office, industrial, and retail, but retail being by far the most notable property type where this would apply to, can be a major driver of your value. It's a bit of a more subtle valuation than some of the other stuff you just talked about, Alex. Owners of retail centers with tenants that may have filed for bankruptcy recently, which we see that a lot nowadays, unfortunately, where a retailer will announce upcoming store closures or bankruptcy, anything like that. If you have those sorts of tenants in your center, there may be an opportunity to pursue property tax savings through an appeal. If you think about it, a retail center with credible, well-performing tenants who are locked in for a long time would more than likely command a higher sell price on an open market than a center with tenants who may be struggling, even if they're at similar rents and similar locations. And on that income approach, it comes down to cap rate. Cap rate's a function of risk, and risk commands what value you can get from a property on the open market, what it's going to sell for. And so when you have these riskier tenants or tenants that could be perceived as riskier, then more than likely you're going to get a higher cap rate and you're going to get a lower sell price for those riskier properties. So that's an avenue that you can pursue. It's usually not something that the appraisers are going to pick up on your initial value. They use mass appraisal techniques. And so it's going to be something you're going to have to bring to them directly, either informally or through the appeal process. But a lot of appraisers are receptive to that argument.
Lucas, walk us through how the protest process works then if a organization decides to protest their assessment.
Yeah, it depends or it varies every time, but this is kind of the same. So from state to state, it can vary, even county to county or jurisdiction to jurisdiction within the same state. It can vary, but there are some similarities. Typically, there will be an assessment notice release date that's pretty standard year to year, with a window to appeal shortly after that assessment is released. We've talked about Texas a lot already. Texas is timely because of the upcoming deadlines it has. But for example, they usually release notices around April 15th, with a deadline to file an appeal being the later of May 15th or 30 days after the notice is sent. And once you file an appeal, you can consider reaching out to the appraisers or the assessors or whoever the authority is to try to work out your protest informally, or you could take it before the board at a formal hearing, depending on the jurisdiction. And so a lot of times it's good to try to work those out informally. It shows that you're being proactive. It shows that you're being transparent. And it goes a long way with building relationships with the appraisers who you have to work with year in and year out. So that's always a good option. But if you can't get anything done, you can proceed to a formal hearing. And if you don't get the value that you think is fair or appropriate for your property through the formal process, you generally have a window to file an additional appeal, whether it be arbitration or litigation. In Texas, that window is 60 days from the formal hearing decision notice being issued. And again, that depends on the jurisdiction. But there are avenues in every jurisdiction to pursue property tax relief. So it's important to know your rules, know your deadlines, and where you can build relationships with those assessing authorities, which will help you for years to come, in our opinion.
Well, thank you, both of you, Alex and Lucas, for this helpful and timely information. If our listeners would like more information, you can go to Deloitte.com and search on property tax, and you'll see some more information about our practice and current topics. As always, thank you, audience, for listening. We appreciate you joining us and look forward to you joining us again next time. Take care and be well, everyone.